China is probably the second elephant in the room next to Mr. Trump.
Hello Philippe, and thank you for joining Dukascopy TV today. So to start off with, a strong dollar is seen as being good for Europe and Japan, and good at guarding and good protection against US inflation. But could it also be considered as a negative?
Yes, potentially so. Actually, we don't think that US dollar is going to rise a lot. It's not our scenario. The US dollar is sort of overpriced at the moment, but still, that's right. With the upcoming reform in the US, the fiscal reform, it's very supportive for the US dollar. A too strong dollar would translate into negative impacts for US firms' competitiveness, also for leverage emerging countries, and for capital outflows in China, and last but not least for the Fed. The Fed might be facing a difficult situation with this, and it would have two major consequences. It would spell volatility in markets and probably more chaotic sort of equity markets. Our strategy in this environment, because we don't think that the dollar is going to rise, is to stay long equities, but with a significant portion of hedges in the portfolios.
So you mentioned China there. In what ways do you expect China to impact global markets?
China is probably the second elephant in the room next to Mr. Trump. China is experiencing significant vulnerabilities at the moment. Political transition is delicate, and the upcoming plenum in next fall is going to be delicate for Mr. Xi. When it comes to the economy, the slowdown is pronounced, is long-lasting, with a lot of leverage in the system, and forex reserves are going down, and when it comes also to the capital flight, it's unstopped. So we expect China to be pretty sensitive to any sort of US friction. It could be on the trade sector, of course, but also on the yuan. In this sort of risk scenario, China would retaliate boldly, in our opinion. It could be a yuan devaluation, a significant one, or it could be the offloading of the significant portion of US government bonds they have. And if one is afraid of this sort of scenario, one good edge would be to buy the US long government bonds. They are becoming very attractive, above 2.5%.
So we talked about the US and China. What do you expect to see from European markets in 2017?
Europe is more sort of binomial. We expect it to be high risk, but also high potential. The odds of a crisis are elevated, of course, be it political crisis with the election in the first half. Could be Greece, it could be Italian banks. You can pick your scenario. Your nightmare is plausible. But still, a lot of things are already discounted in the market, and probably if you look at the price of the bond, it's extremely visible that everybody, it's too sort of a consensus scenario. So a big shock would provide some reaction, political reaction, if not debt mutualization in Europe. So we would consider it as potentially and paradoxically positive. So we stay out of the German bond market, which is very overpriced. The ECB is behind the curve, so even if we don't have any crisis, it's good to be out of this market, but we stay very opportunistic with equities. Good opportunities are probably going to take place.
Philippe, thank you very much.
Thank you.
And thank you for watching. And if you like this interview and would like to see more, be sure to stay with us here at Dukascopy TV.